So Coinbase, why did we sell some? On the day that the insider trading was announced, that's not why we sold it. Actually, it was Coinbase who surfaced or exposed what was going on there for the SEC. But the SEC did weigh in and say, we think that at least 9 securities, I think it was nine of the crypto assets on Coinbase's platform are securities. So there was just, a little bit more uncertainty. Okay, how many of these will they have to delist if they decide not to register with the SEC? Or if they register with the SEC, how will that change their business model? So you saw that we sold very little, but we did, we were in a day where the markets were very volatile and Shopify was down 15%. A little bit of a thesis risk increase in coin. So we swapped some. It was maybe 20 basis points, not a lot. In terms of GBTC, well, we started in 2015 when Bitcoin was at $250. So that gives you a sense of how low a cost base we have. And we've continued to hold it. We wouldn't, I don't think we could use BitO and MicroStrategy. We want the underlying Bitcoin. We're getting all kinds of signals that the economy is very weak. I know a lot of people are focusing on last week's big employment gain in non-farm payrolls. But if you look at household employment, which is a much broader based survey of employment, that has been flat to down for the last 4 months. If you look at claims, we've never seen a faster increase off the bottom than we've just seen. We're up about roughly 50% from the lows. Many people, I don't think, have taken a close look at that. And we're hearing one layoff after another. And we know the Challenger survey says that layoffs are up 55 to 60% year over year. And I think this is all related to inventories. We have a massive inventory glut. And so I think that the last few hires, I think companies were really happy to get them because labor was in short supply for so long. The evidence is piling up. Now, the CPI and in some measure, the PPI, both of those are lagging indicators. The Fed is driving policy off of lagging indicators. If I look at Dr. Copper, the commodity with the PhD, it had been trading for a year in the $4 to $5 per pound range. It's now down to $3.50. It's had a decisive break. And if you look at how that's going to feed into the indexes, it'll feed in slowly to be sure. But just month over month, copper is down roughly 20%, and year over year, it's down roughly 20%. So that's the activity side of things. If you look at the real inflation gauge out there, it's gold. Gold prices peaked in August of 2020, 2 years ago. And we've been in a trading range, to be sure. We're at the low end of that trading range now. Right. If the Fed continues to tighten, we believe the dollar will turn back up and these commodities will continue to fall. We believe we're in a recession. 2 consecutive quarters of real GDP declines is the beginning of that definition. 3 consecutive months of declines in leading indicators, which we have now, would suggest the same. Now, I think the differences are, we see an inverted yield curve, and that, of course, is also a warning sign. I think our point of view is that this is going to be a severe inventory recession, but we didn't have the systemic excesses like we did pre-08-09 in the mortgage market. So it's an inventory recession here. And while most economists are saying, the inverted yield curve points to a recession maybe next year, we believe we'll be coming out of it next year. Now, I think the big question is what's going on in China. I think some of the commodity price decline has to do with China unraveling in some sense from a cyclical point of view. I mean, they've got their foot on the brake in many ways. They're trying to let it off a little bit here and there. But I think that the real estate downturn in China is 30% of their economy, 75% of consumer savings. I think they're not going to be able to control it the way they thought they were. We are going to be 100% invested in innovation. That's who we are. This is what we're paid to do. This is what we say we are. And we think that innovation is going to be a critical allocation in the years ahead as the world moves rapidly. And it tends to innovation tends to gain traction during tough times. Innovation solves problems. We have so many problems right now. We've got the supply chain problems, which we're still hearing about. We've got energy and food prices up because of the war, really hurting consumer purchasing power. And so I think better, cheaper, faster, more productive, more efficient, more creative. In terms of returns, I have to be very careful in terms of, we can't promise anything. But if you're talking about the backdrop, if inflation were truly embedded in the system, 70s style, that would not, as the markets were adjusting or would be adjusting for that, that would not be a good time, because interest rates probably would go up a lot. In fact, one of the really reassuring developments recently has been the drop in long-term interest rates. The 10-year Treasury yield back to closing in on 275. It has not been able to maintain anything above 3% for very long at all. So the bond market is basically saying, no, this is a very good time. Tesla, if you're analyzing cars, not by brand, although its brand certainly has done wonders in the last few years, but if you look at range and power, the combination of those, most other auto manufacturers, unless they want to lose money on the cars, most are not going to be able to keep up with or to reach Tesla's combination. So that's very important from a performance point of view and a range point of view. Branding is something different. These other auto manufacturers have brands and a lot of brand loyalty. But I think as consumers start to shift from gas-powered to electric and look at the specs of the different cars, they might still be persuaded by brand only, but they won't have as good an electric vehicle as Tesla will provide. And actually, we've been studying the CapEx schedules for traditional automakers versus Tesla. Tesla is now within the next year or so is going to spend more on electric vehicles, if it is not already, than either one of those companies. So here were the behemoths where, 5 years ago, when most people were saying, Tesla doesn't even have a shot to exist. It's going bankrupt. Now it is spewing out cash and spending as aggressively as it can to roll out new plans. And we think they'll announce another one before the end of the year.